Today we're going to briefly finish off the discussion of unintended consequences of price controls. So, one thing that remained that we haven't had enough time to discuss last time was the price floors. And how price floors influence market equilibrium or disequilibrium, and what are the unintended consequences of price floors. So price floors, to remind you, are situations whereby supply of goods exceeds the demand when the price is lower than the equilibrium price. We have a situation where the quantity demanded for that good is quantity supplied is smaller than quantity demand. I haven't had my coffee today. So this is the demand curve, this is the supply curve, equilibrium level. We're talking about price floors. So price floors are situations in which the government, for whatever reason, orders everybody to charge higher price than would have existed on a free market. It's price floor. You cannot charge lower than this. So the consequence of that will be that quantity supplied will be greater than quantity demanded. It's called surplus. Surplus and the problems now, just 5 to 10 minutes to briefly explain what kind of consequences happen if and when the government tries to impose and maintain a price floor. A classical example or a classical case of price floors would be minimum wage laws. So you have $10 minimum wage, the government says everybody has to pay $15. So you will have an increase in supply stemming from obviously higher pricing, and we have a decrease in demand. An excess unemployment will result as a consequence of that. And on a genuinely free market, what would have happened actually, that the price of labor would have to go down in order to equalize supply and demand. If you don't allow that to happen on a free market, then the alternative ways of re-establishing the equilibrium will kick in. So one of the things that will happen, or that could happen as a consequence of a high minimum wage, is that the shift in labor demand from low-skilled people to higher-skilled people. So that's the first possibility. Labor shift. Shifting the labor in the demand for labor. What that means? That means if you have a need for somebody to work for $10 and to perform certain activity that is worth $10 to you, and the government says you cannot employ that person, you have to pay at least $15, then what happens is that you're very likely to try and find somebody who is worth $15 to you rather than $10. So you're going to pay, if you have to pay somebody $15, you're at least trying to make this person work or create $15 of value. So you're not very likely to employ this person here with very low skills who can create only $10 for you. You're going to replace him or her with somebody who is more productive. Older workers with more skills typically can qualify on a free market for higher wages. So you're going to hire somebody to work the minimum wage job plus something else that a mere minimum wage worker could not have done. So now I have a shift in the demand for labor. If the government didn't intervene to impose the price floor, to impose the minimum wage guarantee, you would have employed a lower skilled worker. Now the demand shifts to higher skilled. workers. So contrary to the original reason for the minimum wage, to help the standard of living or to provide a living wage for the poorest people, actually you are penalizing poor people and you are subsidizing more qualified workers. Can qualify for higher wages even in the absence of the minimum wage guarantees. So that's one shift that is going to happen. That's one unintended consequences, one of the ways in which unintentionally you are hurting people whom you wanted to help is actually by replacing them with more productive workers. The second shift, or the second substitution effect that is going to happen is substituting technology and machinery for labor. So then imagine that at $10 for minimum wage, you could have performed or you could have produced the same economic value by replacing a worker with a machine. So we know that there is a substitution always. Substitution is always possible. There are millions of possible combinations of factors of production, labor and capital and raw materials by which you can produce anything. And you try to choose as an entrepreneur the most productive and the cheapest one. So imagine that you can produce the same good with a machine that will cost you $12 per hour to rent or to buy. If there is no minimum wage, you're not going to do that because you will have to pay $2 per hour more. So the minimum wage worker on a free market is cheaper option to you than a machine. And imagine that you impose the $15 minimum wage now. This is not available to you anymore. This option is outlawed. What used to be a losing business proposition now is a superior option. It's far better for you to pay a machine $12 rather than a worker whose value is $10 to pay $15. So one of the effects of minimum wage laws is actually to further encourage, to further push the technological substitution of labor. You can see that in any number of industries. McDonald's is a classical case in point. You already have a tendency of a certain level of robotization and replacement of workers with machines, but the minimum wage laws are one of the factors that increases the pressure, that amplifies the pressure for this. By making labor artificially more expensive, it makes correspondingly machinery and technology more appealing to entrepreneurs. To the extent that you can substitute between machinery and labor, and in many industries you can do quite a lot of that substitution, then the labor is going to pay the price for that. So any measure that makes labor artificially more expensive hurts the wages of working people by making them less competitive against the machines, against the technology. Okay, so that was just a very brief overview of the price floors. So price floors are all kind of regulations that put the minimum price guarantees that you have to impose, that you can charge. And they're always enacted at a level which is higher than the equilibrium market rate. And the effects are these, that you're perpetuating or freezing the surplus that exists on the market. The market wants to eliminate the surplus, and you prevent it from doing so. So this surplus supply of labor here that exists, the minimum wage, simply will remain in place forever. So it shouldn't shock you that the unemployment rates of American teenagers are far higher now than they used to be 30, 40, 50 years ago. There are many factors influencing that, but one of the primary ones are minimum wages. And especially the youngsters, uneducated youngsters from minority communities, from the poorest communities in America are hit the hardest. So we have one dismal statistic actually that the unemployment rate among teenagers and young people went up dramatically. But among African Americans, it went up like 2 or 3 times more than among white kids. Because the African American kids on average come from poorer communities and their level of education is on average is lower than among white kids. And you may say that, that's maybe racism, discrimination, and so on that caused this disparity. But then when you look 60 years ago, in 1940s, 1950s, 1960s, the level of teenage unemployment among black kids was lower than among white kids. At that time it was lower, now it's 2 times higher. So the minimum wage is one of the key reasons. Okay. Any questions? Comments? Oh, nothing. Okay. Okay, then we'll switch to the next chapter and we'll begin with the theory of profit and entrepreneurship. That's the core stuff that we want to enter. Entrepreneurship. So people usually say that the free market capitalist system of economy is based on profit. That's a profit-driven system, which is not quite correct. It's based on profit and loss. Profit doesn't work without loss. So we have to understand the phenomenon of profit and loss if you are to understand how the market economy works in general. So we're going to do a couple of things. We'll start with the definition first. A very simple-minded, simple definition of profit. Then we're going to try and distinguish between profit and other types of income that exist in a market economy, like wages, rents, and interest. See what are the difference between these types of income, how are we to understand them, and profit. How profit fits into the analysis of wage, rent, and interest incomes. Once we do that, we're going to complicate a little bit our initial simple-minded definition of profit by drawing a sharp distinction between what we can call accounting profit, accounting versus economic profit. The fourth thing would be then to connect profit and entrepreneurship. What entrepreneurs do, what is their role, how they do it. Is it only one thing, or are there maybe a couple of things that entrepreneurs do at the same time, and so on. And finally, we're going to wrap it up by saying something about the problem of economic calculation in entrepreneurship. So that's a game plan for today. These are the key concepts. There will be a few others as a part of the analysis, but this is like the roadmap for us. Definition of profit and loss, profit versus wages, rents, and interest, the difference between accounting and economic profit, profit and entrepreneurship. Okay, let's start with the basic definition. How would you read the point number 1 here? Can you define profit and loss for me? Now, how would you define profit and loss? What other categories you need to use in order to? Definition means saying something about a concept that you don't know anything about by reducing it to other known concepts. Okay, so which other concepts you can use to define profit? Revenue. Okay, good. One is revenue. Can you define then further revenue? What is revenue? The amount of money that you make out of products. How can you calculate the revenue? Please explain. Let's say that you are selling one product. How you calculate your total revenue? No, total revenue. We are not talking about marginal revenue from selling one additional unit. The total revenue, everything that you sell over a period of 1 month, for example. Yeah. How you calculate your selling total? Price times quantity. Price times quantity. So we have very rigorously defined the first concept that we need in order to understand profit revenue. Total revenue equals total number of units sold times price per unit. We assume now that all units are sold at the same price. What else do you need in order to understand, to define profit and loss?
How much it costs to produce?
So cost of production. Okay, so what is the simplest possible, simplest possible definition of cost? Expenses. So, what would that mean? Everything that you have to pay in order to produce the quantity here. So let's say price 1 times quantity 1, whatever the electricity, plus price 2 times quantity 2, wages plus you name it, any number, let's say 6, 7 items, to simplify. You add them all up and you get the cost of production. So as you can see, they're expressed in the same units, in dollar terms. Price electricity per kilowatt times number of kilowatts that you use. Price of labor of a certain kind times the number of workers that you paid per month, plus a price of a raw material per unit of weight times the number of, or the quantity or the weight of the raw material that you got, and so on down the line. Now, profit is equals, what is this now, the formula? Revenue minus costs. What this differential between revenue and cost has to be for us to say that the business is profitable? Yeah, greater than 0. So revenue minus cost greater than 0. If it's smaller than 0, that's a loss. We'll see very quickly, in 10 to 15 minutes, that this is not enough for a complete analysis of profit and loss. We need some additional data here. This is the accounting view of profit, which means you account for all the objectively paid costs and you see what your revenue is and you compare them. Now, if we we were to compare profit to other sources of income, the things become a little bit more interesting. Because this division in classical economics, with Adam Smith in 18th century onwards, even to this day, you will find in the textbooks that the total social product, everything that we produce, is then paid through wages, rents, and interest incomes. So wages are, how would you define wages? That's a compensation for what? Yeah, for labor services. What are rents? Yeah, for renting something. That something could be usually an apartment or real estate, but it could be a machine in a certain sense. It could be a piece of equipment, any piece of property that you can lend to somebody for a specified period of time. So it's a compensation for borrowing a physical piece of equipment or real estate. Sometimes, now you can see that there is a certain connection between wages and rents. You can think in a certain way of wages as a rental incomes, because what you are doing as a worker, you're lending your labor to your employer for a certain period of time, and you are compensated for that. Yeah. I sign a contract that I need to teach you this class every Thursday and every Tuesday, so in that time period I cannot do anything else. It's a sort of rental contract between me as an employee and the university as an employer. So there is a certain connection in a certain sense. It's the more sophisticated forms of economic theory actually try to reduce any talk about wages to the rent theory. So it doesn't matter from a standpoint of economics whether a factor of production is human or non-human technology. Workers and machines, as we just saw with minimum wages, are substitutable. You need all of them at the same time. They're complementary factors of production. So you need both machinery and raw materials and human labor in order to produce anything. In different proportions, of course, but you always need all of them. So wages and rents are different types of compensation for the services of either human labor or services of non-human factors of production, such as machines, equipment, real estate, and so on. What are interests? Interest income. What is that? So interest rates, interest income. The money that you pay as a part of which transaction? What kind of transaction is involved here? Loan. Is the loan word that you used? Yeah, well, the lending and borrowing transaction. So it's a lending, is a compensation. For lending services. Again, the same thing, actually. You're borrowing capital. It's a compensation for making your capital available to somebody else for a certain specified period of time. The interest payment is a compensation, you can say, is a compensation for waiting for income. Because when I lend you $100 on 3 months, for 3 months, what I'm doing actually, I'm exchanging $100 of present money that I can use to buy some consumer goods right away for your promise to pay me $100 in the future. So now present consumer satisfaction is more valuable than the future consumer satisfaction to everybody. We don't like to wait because our time horizon is limited. We are mortal, so all other things being equal, we always prefer present or more recent, more less removed in time satisfaction to a more distant satisfaction. So then the interest payment is a compensation for waiting, compensation for the sacrifice of present money for the future money. So these three types of, so we usually say that wages are incomes of workers, rents are incomes of rentiers, people who just lend their stuff to other people, and interest is an income of investors or savers or lenders. Sometimes in classical economics, rents were considered to be unproductive incomes because people couldn't understand quite correctly what is the productive contribution of these goods and services that are rented to somebody, and they then thought, okay, wages, I can see why wages should be compensated for because people are working and producing stuff, but it's difficult for me to see what is the reason that somebody who rents a machine should be paid a compensation for that. That was understood later on. We'll discuss it later in the semester. What is the proper theoretical framework for thinking about these three types of income? For now, we're going just to limit ourselves to one crucial thing that all of them have in common, as opposed to profit. Because after all, we are after profit and loss today. That's what we want to explain, actually. Wages, rents, and interests are contractual incomes. Contractual. That means we make a contract and I pay you $105 if the interest rate is 5%. If I don't pay, you can sue. We make a contract that I'm going to pay you $3,000 per month gross wage. If I don't pay you, you can sue. I borrow a machine for you, I rent a machine for you, and we sign a contract that I have to pay you $200 per month. If I don't pay, you can sue me for breaking the contract. So that's what is meant by the idea that rents, wages, and interest are contractual incomes. Profit, on the other hand, is a non-contractual income. The easiest way of understanding what profit is say that the profit is a residual income. So that's a dichotomy between contractual versus residual income. What is residual income? That means anything that is left after the whole process of production has been completed. Any residual. That means these are your costs of production. Wages, let's say you employ certain workers, you rent machines, office space, you buy your factors of production, you borrow money from a bank and so on, you have to pay the interest plus principal every month, whenever you need to pay. Once you pay all your contractual obligations, all your costs, and you sell the product, you have a certain revenue. Anything that is left over, above and beyond this is profit. That's what is meant with the residual income. What else is different between interest, wages, rents on the one hand and profit on the other hand? What do you think? Have any idea? Let's think about the entire process for a moment. Can you make a contract with somebody to guarantee your profit? Why is that? Can you insure your profit with some insurance company? Why would nobody insure profit? So profit is connected with uncertainty and risk taking. So you can say in a certain sense that the profit is a compensation for uncertainty bearing or risk taking alternative. So a better term, profit is always connected with uncertainty. Uncertainty about the future. Uncertainty about the consumer demand. Uncertainty about how much you would sell. About your future revenue. Uncertainty about some cost items that might get more expensive in the meantime. So profit is a type of income that accrues to the owners of capital, usually, to entrepreneurs, let's say. Profit is a source of income that accrues to entrepreneurs whose main hallmark, whose main principle is that it compensates the entrepreneur for uncertainty bearing, for dealing with uncertainty. So you see, I'm an entrepreneur, I employ all of you. So all of us take certain risk, but I take the residual risk. What does that mean? That means we need to produce something and it will take us a year from start to the point when we have the opportunity to sell our product on the market. So in that time period, we don't know whether we're going to succeed or fail. But I have to pay you the wages all the time while we are producing the good, not knowing whether we're going to succeed or fail. And I have to wait for income until we start selling the product. And I don't know whether the revenue that we're going to create will be enough for me to cover all of the costs, including your wages. So once we start selling the product and it turns out that the revenue is higher than the costs, then you don't have any further claim to this residual income. That is my income. It is a compensation for my risk taking, for my living with uncertainty for a year. You didn't have to live with uncertainty. Your wages were paid for the whole period of time. I didn't get any income during this 1 year period. So then I'm compensated for this. So the main characteristic or the main aspect of profit is compensation to entrepreneurs for successful uncertainty bearing. Now, why I'm using what is the most usual, the more usual term that is used, that is commonly utilized in this context is risk taking. Risk taking, I'm using the term uncertainty bearing, which is a better and more precise term. Why? Because risk is a type of uncertainty that could be, at least in principle, mathematically modeled and predicted. So that means there is a 10% likelihood of something happening. When you roll a dice, there is a 1/6 probability that the number 2 will come up. That means with a sufficient level of repetition, if you repeat many thousands times, 1/6 of the time the number 2 will come up. So that's a principle. So risk is mathematically calculable uncertainty or probability. So risk is tightly connected to probability, to the calculation of a probability. You know any business that deals with this, with the risk and insurance against risk? Insurance business. Risk premiums, insurance premiums reflect the risk of something happening. How they know what the risk is, they don't know precisely, but they can guess. How can they guess that? By looking at the statistical data and saying, what is the likelihood of the young man of 25 with a previous history of car accidents and with proven whatever habit of drinking alcohol is going to have an adverse event or car accident and so on. And they look at the database and they see out of how many people whom they have in the databases, how many car crashes happen. And they say the likelihood of that happening is 15 times higher than with some 55-year-old lady with no previous history of drinking or whatever, reckless driving. So then they charge the insurance premium to person A higher than to person B because they have a certain statistical basis to calculate the probability of something happening. It doesn't mean that every person who fits certain description will have an adverse event. It means that on average, with a large number of people involved, larger the better, actually the number of them who will have the accident will correspond to a certain statistical average. The same is in health insurance. So they don't know who exactly is going to have a heart attack, but they can calculate that people with heart disease and high blood pressure or diabetes will have 7 times, 15 times greater likelihood of having a heart attack. So that's the reason that then why insurance on a free market will charge a higher health premiums to people with pre-existing conditions than to young healthy people. So you can quantify uncertainty in a certain sense in insurance. Now, you cannot do that in entrepreneurship. You cannot quantify what is the likelihood of failure or success. Why is that the case? That's the case because you're dealing with the same type of events when you model insurance business. How many people with pre-existing conditions had heart attack? So you can compare apples to apples. You know the universe of all possible events and all possible people who are involved. The universe of possibilities. So then you can calculate statistical averages. You don't know what factors can influence profitability or failure or a business loss at all. You are in a complete darkness. Why are you in a complete darkness when you think about profitability? Can you tell me? Why nobody can predict whether a firm is going to fail or succeed, and to put any probabilistic estimate that. Because you cannot predict the future demand, and you cannot predict the future innovations that will influence the demand and supply. The only way to predict future profitability is to predict the future in a strong sense, in the sense of predicting what people would want in a year or 2 or 5, and to predict what kind of new means to satisfy those needs will entrepreneurs invent. How many people predicted any great technological invention in the last 50 years? Not very many. So the forecasts are very risky, especially if they're about the future. So predictions are very risky, especially if they're about the future. So you cannot use, in business, you cannot use past as a model to understand what's going to happen in the future. Whereas in insurance business, to some degree, you can do that. Because that's the same process repeating all over again, people driving cars. It may change slightly, but in general, it's the same thing. What is the influence of diabetes? What is the statistical relationship between the incidence of diabetes and heart attack? You know what you're talking about. You know what you are comparing. Here, what is going to influence the demand for laptops in 5 years? God knows. There are millions of factors that can influence it. Maybe people will completely scrap laptops and turn to something completely new. When I started using mobile phones, dear God, it was almost 20 years ago. Some of you may not have been born. You know what what a laptop, what a mobile phone was? It was just a device that you use to send text messages, very expensive, and to make calls, also very expensive. And it was like a brick. And you are very proud that you have a mobile phone. You're not confined to a landline. Who could have predicted on God's green earth this thing right now that you can use for all kinds of functions of a computer, of whatever, GPS, navigation, any surfing the internet? You know much better than me. Listening to books, listening to podcasts, doing any number of things that didn't exist even 18 years ago. So now you can just think 20 years down the road when you are my age, what kind of products will be on the market and what people would want to buy. Nobody can predict it. And entrepreneurs are in the business of providing future services. That's the problem. So then if I come to you, you're an insurer, and I say, you know, sir, I'm in this high-tech business, I would like to insure my profit in the next 10 years. If I fail, I'm going to be paying you every month, and then if I fail, you pay me back. So get out of here. How could I know what is the risk of you failing? I have no idea. The firms that looked perfectly profitable yesterday, something new was invented, they fail completely. That's called creative destruction in economic theory. Creative destruction. The role of innovation. When I was in 1990s in my college days, you wouldn't believe me probably, but it's true, I swear. I was working in a newspaper as a journalist, and how I would type my articles was on a typewriter that I borrowed from my uncle, who got it from his uncle from America 25 years ago. A Brazilian Olivetti, nice typewriter. So I would write down like a long hand the article, and then I would type it on a typewriter, and then you put you know how that works. You put a piece of paper, and if you make a mistake, you scrap it and start all over again. That's the way how I was in 1990s writing newspaper articles. You know, imagine what happened to Olivetti first when the personal computer came along. It just disappeared. So I imagine in 1981 or 1978, Olivetti looked like the most profitable firm on the face of Earth. Who could have predicted that it was going to fail in a brief while? So that happens every day. New things are created, and the old things are eliminated. And then the new creations create new needs and new wants that didn't exist before. So then the profit as a source of income, in a certain sense, compensates all of that. This constant dealing with uncertainty. You have to pay the costs right now in no uncertain terms, and to expect uncertain future return that neither you nor anybody else can predict. If you want to motivate people to do hard things, then you have to compensate them for that. So whenever you hear next time like outrageous profits in the big business and so on, think about what I just told you, about what they actually do, those people. Imagine that that something is the most important thing in your life, and that you have to live in uncertainty every single day whether you're going to get that or not. Whatever that might be, material or non-material thing. If you want to motivate somebody to live like that, you have to offer him or her a relatively high reward. What we as a society have of that? What is our benefit? So they get profit because they. What is our benefit? What is the benefit of every one of us because Jeff Bezos has astronomical business profits? Or Bill Gates, or whomever. I was going to say Donald Trump, but after his tax returns were released, I'm not sure anymore whether he has much profit or not. But at any rate, any successful business. What is the benefit for society? Yes, so we get the services that we didn't have before. And the fact that we like the services, we prove by voting with our dollars. So that's one benefit. Consumer benefit, consumer surplus that we derive. But also from a standpoint of society. Remember, scarcity. Resources are scarce. They could be used in any number, in a million different ways, to produce a million different things. Once you get a profit as an entrepreneur, that's a signal to society that you improve the value of those scarce resources, that you created something that people value more than the things that you used up in the process, that you sacrificed in the process. So here, whatever your widgets that you sold on the market and earned the revenue enough for you to earn the profit is more valuable to society than the sum total of electricity and wage labor and raw materials and office space and so on that you used up in the process. Society values what you produced more than what society sacrificed for you to produce that. How do we know that? Because we have a unit of measurement, which is called money, monetary calculation. Okay, so this is economic calculation is a necessary precondition for the functioning of the profit and loss system. Monetary calculation is the only way to create a common unit of measurement for costs and revenue. Imagine that you're doing the same thing, hiring labor, using electricity, using office space, using raw materials. How would you know whether you are profitable or not if there were no market prices, monetary prices for every single item that you use, including the revenue, including the final product that you are selling? You wouldn't have any way of telling whether you are making a good business move or not. Okay, so that's about risk-taking versus uncertainty, and profit as a compensation for uncertainty. There. Any questions to this point? Okay. But let's go to this thing, accounting versus economic profit. So thus far, we use this simple definition of profit as a difference between total revenue and total cost. And the way how we define cost was a bookkeeping or accounting view of cost, which means you add up all the expenditure items that you have, cost items, and the sum total is your cost. But now I want to remind you of something that we began the semester with. concept of opportunity cost. We've seen that the true economic notion of cost has to involve not only the explicit monetary expenditures, but also opportunity cost, the value lost by doing X rather than Y. So we can say for society, for us to understand the success or failure, to assign the designations of profit or loss to a business enterprise, accounting profit is enough. That's the only objective thing that we can know as a society. When you look from the outside, business enterprise is profitable, which means revenue higher than cost, is not profitable, cost is higher than the revenue. Okay, so that's the accounting concept of profit. However, the true economic profit, in the sense that it takes into account the opportunity cost of everything that we do, is a little bit more complicated. And this economic profit is an explanation of why people do what they do. So, in order to understand whether a certain entrepreneur is going to do X or Y, we cannot take into account only his explicit costs. Explicit cost, it means these things that you pay for as a process of production. You have to take into account also implicit cost. So you can say that the formula for economic profit is revenue minus, in bracket, explicit plus implicit cost. And you can say the law of human action is that an entrepreneur is going to undertake a business venture only if in his mind at the moment of choice he or she gauges that the future potential revenue, uncertain revenue that he anticipates, by anticipating future demand and hoping that his assessment is correct, will exceed the sum total of explicit costs that he will have to pay, plus the opportunity cost of him doing that, which means the value that he would be losing by undertaking that business. Money that he could have earned elsewhere if he had not undertaken this business. So the concept of economic profit is a concept that we need in order to understand the decision-making mechanism of an individual entrepreneur. It's tied to an act of choice. It is connected to opportunity cost. So one simple example to illustrate this. Imagine that you have a person who earns $30,000 in wages per year. And let's say that she has, let's see, $10,000 in savings. $10,000 per year. $10,000 interest income. That's it. $10,000 in savings. So that's what she does in general. Whatever, working as a secretary and having some like a deposit, certificate of deposit, savings worth $10,000. So the total income here is $40,000. Imagine now if this person wants to start a business. And imagine that this person anticipates, wherever in your book they use this example of a pizza restaurant, any new business venture. And that person anticipates a total revenue of $85,000 per year. We don't know. She doesn't know whether this is going to materialize, but that's the best estimate, the best expectation that she has about the future revenue. And imagine that the sum total that the person has her own, like the space or restaurant space, and the expected explicit costs, like the raw materials, labor costs, electricity, machines, and so on, are 43,000. Per year. Well, let's say 46,000. Will this person quit the job and cash in her life savings to start this business enterprise? Well, let's simplify it even further. Let's say $40,000 in wages. Just to make it simple. Will the person quit the job here to start this new business venture? Expected profitability is the criterion that a person will use in order. Economic profit is a criterion. Expected economic profit is a criterion that the person will use to make a decision. So what would be, if this is correct, the accounting profit here would have been whatever, $39,000. And then is it worth her while to do it? So economic profit is an explicit plus implicit cost. So what is implicit cost? Opportunity cost of her labor. So here she is losing. She will have profit here, $39,000. But at the opportunity cost of $40,000 that she loses by not working her job. So 81 minus, in bracket, 46 plus 40 equals 86. So in the economic sense, she would be $1,000 worse off. So she probably was not going to undertake this business investment. So you see, it's not enough for some clever accountant to come to her and say, okay, you expect $85,000. I can figure out a very clever way to pay $50,000 or $45,000 cost. Can't you see $35,000 of pure profit? What's not to love here? Yeah, what's not to love here is the problem of opportunity cost. That an individual business decision maker does not take into account statistical averages and raw numbers. He or she takes into account subjective opportunity costs. So if you expect to earn $40,000 working on your regular job, and you can earn implicit wage. So this is here implicit wage. This would be technically a profit, but that's implicit wage. That's how much this person would be paid for running a restaurant here, $39,000. So that's lower than $40,000. So she wouldn't undertake. If it were $43,000, then it makes more sense, and it's $2,000 positive economic profit. So see, accounting profit, to summarize, is a category that we as a society can use to see whether any particular person increased or decreased the value of societal resources. We don't care about why they do it, or for which reasons they do it, or whether that they made a miscalculation here, that they missed some other better opportunity that they could have had. We only worry about whether the value of resources that are being used was increased or decreased. However, if we want to be economists, a more serious kind, we have to worry also about how and why people make their decisions. What are the criteria that they use when they make their decisions? And the main criterion that they use is the concept of economic profit. That involves both the expected accounting costs as well as the implicit opportunity cost. Okay? Any questions about this? Okay, just a few more things about the entrepreneurship, profit and entrepreneurship. We've seen already the main thing is this uncertainty bearing. That's the main hallmark of entrepreneurship. Another one is innovation, creative destruction. Invent new things, transform the landscape of the business branch in which you live, invent new business branches, invent new industrial fields, new products, and so on. Invent new ways to satisfy the existing needs, create new needs that didn't exist before. So all of that is creative. Why creative destruction? Because you create something new, and in the same way you undermine or destroy the old ways of satisfying needs. My need to type down my articles as a young journalist was satisfied by an Olivetti typewriter until the point when I had enough money to buy a personal computer, and then the same need was satisfied by, and the Olivetti, like the typewriting industry was destroyed. Cars and trains destroyed, the boogie horse and boogie industry, and carriages and so on. Airplanes are in the process of kind of all but obliterating the buses in the United States as the means of transportation. Railroad transportation is also in decline, so we cannot. Who knows what is going to be the dominant form of transportation in the future? So that's creative destruction. What else? Entrepreneurs do. I'll give you a few examples. We have just 7-8 minutes. So a few things that are important about entrepreneurs. Remember, shortages, surpluses. We always said, like in an imprecise, generic sense, like the market will equilibrate. The market, if there is a surplus, if there is a shortage, the market will do this, the market will do that. But actually, who does these adjustments are entrepreneurs. Entrepreneurs are arbitrageurs. They earn by arbitrage. What is arbitrage? Any idea? They have one important, all entrepreneurs have one very important quality, that's alertness. They are alert to business opportunities. So even if they are not particularly innovative, to create new products and to revolutionize them, not everybody is a Steve Jobs or Bill Gates or Jeff Bezos, but all entrepreneurs have to be alert to business opportunities. What does that mean? What does that mean? What is arbitrage? Anyone heard about it? Your business. That means you find an opportunity to buy something cheap and to sell it more expensive. To earn on a price differential. So you have to be alert to the specific information about the increased demand for something in one area vis-a-vis another. So then this allows of entrepreneurs to price differentials leads to the equilibration of prices across the market. Because if there is a difference in prices in two different things, somebody will figure that out and will start buying where it's cheap and selling where it's more expensive. By increasing the supply where it's more expensive, the price will go down. By decreasing the supply where it's cheaper, the price will go up. So then the equilibrium will be established. So entrepreneurial alertness and arbitrage are the main reason. For something that I didn't mention to you. You will learn in microeconomics classes that something called the law of one price. It says that for every single product, if you define product as one discrete thing, there will be one and only one price in the market. Or, to be more precise, there will be a strong tendency towards only one price existing. What is the reason for that? The reason for that are entrepreneurs, arbitrageurs. Because if there are more than one price, people will start buying, entrepreneurs will be motivated to earn more money by buying where it's cheap and selling where it's dear. And by doing so, they will reduce the price spread between the two areas. So you don't need any government edicts and any regulations. You don't have to worry about whether there will be one price or not. There will be, probably, if you allow entrepreneurs to take advantage of any kind of unjustified price spread. Okay, so to conclude, profit and entrepreneurship are intimately connected. Profit and loss are types of income that entrepreneurs derive. Profit is a compensation for successful risk-taking, or to be more precise, uncertainty-bearing. They're different from wages, rents, and interest profits because they're not contractual incomes. They're not in advance established and defined in contracts. They're residual incomes, which means everything that is left over after all costs are paid and revenue collected. Entrepreneurs, so residual claimants, that's sometimes called, people who claim any residual income that remains. There is a significant difference between accounting and economic profit. Accounting profit reflects the value of what entrepreneurs do for society, whether their revenue is higher or lower than the value of costs or things that they sacrifice, whereas economic profit, by virtue of including opportunity cost within the cost item, reflects the subjective value of business enterprise for entrepreneurs. Entrepreneurs will undertake any venture only if they estimate that the expected revenue will exceed the sum total of explicit cost plus opportunity cost of them doing so. So that would be pretty much everything that you need to know about this. Any final questions? Okay, if not, then let's call it a day, and I wish you a nice weekend. And I see you all next Tuesday. I will open up the new homework assignment probably tomorrow afternoon.